First of all, if you look at in terms of return, it's not that we are sitting at an abnormal return. Say, for example, if you look at in October 2021, Nifty was at 18,400. In December 22, Nifty was at 18,800. So from those levels, it's not that the market has run up a lot. In fact, if you look at from the last 2-year return, CAGR return is lower than the long-term average return. So first of all, the perception that the market have run up a lot really depends on from which time horizon you are looking at. Second thing is that whether this rally is justified. We think this rally is justified. As you know, we follow a 5-factor fundamental model to evaluate the market. These 5 factors are macro fundamentals, corporate fundamentals, domestic liquidity, foreign liquidity, and valuations. So far as the macro fundamentals are concerned, India's macro fundamentals are extremely strong. The last quarter, we clocked a GDP growth of 7.8%. According to the forecast of the RBI, which has been reiterated today, India will grow by 6.5% for the full year. According to the IMF estimates, India will be the fastest growing major economy for each year between 2023 and 28. So, and it's not just GDP. If you look at other numbers, for example, if you look at GST collection, if you look at air passenger traffic, if you look at the industrial production, if you look at the infrastructure production, if you look at the purchasing manager indices for both manufacturing and services, all these are suggesting that India is doing substantially better than the peers. So the macro fundamentals for India are supportive of a continued rally in the market. If you look at the corporate performance also, we had seen that between June 22 and June 23, there were a significant amount of input cost pressures for the Indian companies, and consequently there was a margin dip. But by June 2023, we have recovered that margin. So the corporate performance also, whether you look at the top line level or the bottom line level, corporate performance has been robust, especially adjusted for the raw material cost. And going forward also, we think the corporate fundamentals will remain largely stable. So that is also supportive of continued equity market rally. If you look at the foreign liquidity, we had seen huge amount of outflow from Indian equities in 2022, but similar amount of money has already come into India during 2023. So foreign liquidity has also turned positive for India. Given the strong macro and strong corporate fundamentals of India, we don't see any reason why should there be a significant outflow from India in the next 9 to 12 months. So far as the domestic liquidity is concerned, this has been the biggest support for India, not just today or not just post-COVID. If we look at from 2014 onwards, the domestic flows towards the equity market has gone up very, very significantly. The share of mutual funds in free float market cap has more than doubled. The number of demat accounts, the number of equity folios with the mutual funds, all these are growing at a very high pace. So domestic liquidity is the biggest support to the Indian equity market. That brings us to the 5th factor, which is valuation. Now, if you look at valuation in terms of the earnings for the first 12 months, currently Nifty 50 is trading at a multiple which is slightly higher than the last 10-year average, but slightly below the last 5-year average. So it's not, even if you are looking at a backward-looking basis on the market valuations, it's not that it's overstretched. And if you look at on a forward earnings basis, even if you factor in a 10-11% earnings growth over the next 12 months, Nifty is currently trading at below the long-term average. So the valuation, at least for the large caps, are not stretched. So we don't expect even valuation-led corrections. So far as the mid caps are concerned, this is one segment where the valuations both on a last 12-month basis or on a forward basis is looking a bit stretched. And therefore, after the strong rally in the mid cap companies, this rally might lose some momentum. There may be some short-term corrections also, but that the same is not true for the small caps. In fact, if you look at over a 5-year period, small caps have underperformed both the large cap and more so the mid cap. And the earnings traction for the small cap is significantly stronger. So therefore, along with large caps, we also expect the small caps to perform pretty well in the next 12 months. So overall, we think 10-11% kind of a return at the Nifty 50 level over the next 12 months, and significantly better return so far as small caps are concerned. There may be some level of underperformance for the mid cap. So that's largely speaking is our view on the equity market.